So, welcome to the deep dive. Today we are focusing on an absolute titan of the market, NVIDIA.
Yeah.
You look at their recent Q3 FY26 reports, their filings, and you just see this incredible, almost unbelievable surge. It's all driven by the AI boom.
It's an amazing performance story, full stop. But our challenge today, is to take that story, this high-flying narrative, and really ground it.
Grounded how?
With the most rigorous, skeptical framework we have. The principles of Benjamin Graham, the father of value investing.
All right, so our mission here isn't to look at this like a growth investor who's just excited about the future. We're putting on Graham's very conservative glasses.
Exactly. And we're going to pin our analysis to a specific price. Let's say $180 a share, which is right around where it's been trading.
And the big question, the really tough question is, at that price, do you get what Graham called a margin of safety? Or is it, just pure speculation at this point?
And that's the conflict, right? Because the whole thing starts with the company's profitability. It's just staggering. Before we can even criticize the price, you have to acknowledge the quality of the business.
The numbers are, frankly, hard to believe. They're so far outside the norm for, like, a hardware or semiconductor company.
Let's start with the Q3 net margin, 56%.
56. So for every single dollar that comes in, they keep 56 cents as pure profit. It's incredible.
And that margin leads to this astronomical return on equity. The ROE for the last 12 months is sitting right around 100%.
Can you just break that down for our listener? An ROE of 100%, what does that actually signal?
It means for every dollar of shareholders' capital in the business, the company is generating almost $1 of profit every year. It's a measure of efficiency that just screams pricing power, a massive competitive moat.
Okay, so they're using their capital incredibly well. But margins like that, they can't last forever, can they? They basically paint a huge target on your back.
Exactly. And that's where Graham's filter comes in. When you take this amazing quality and you run it through his valuation test, that $180 price tag, it doesn't hold up.
This is where things really start to diverge, isn't it? The business versus the stock.
Let's just take the standard price to earnings ratio, the PE. Based on the last 12 months of earnings, it's already high at about 44.7 times.
So 45 times earnings, that's already pushing it for a conservative investor. But Graham was always worried about these, temporary spikes in profit.
He was. He didn't want people getting fooled by a boom year, so he insisted on normalizing the earnings, smoothing them out.
By using an average over a few years.
Exactly. So we use the 3-year average earnings per share, which is about $1.43. And when you calculate the PE based on that normalized number, well, it skyrockets.
It doesn't just climb. It explodes to, around 126 times?
126 times normalized earnings. Now just think about Graham's absolute ceiling for what he considered a safe defensive investment.
15 times.
15. We are paying over 8 times his maximum. That number, 126, it isn't just high. It tells you everything you need to know about the speculation that's priced in.
And if you flip that PE ratio, you get the earnings yield, right? The sort of return you're making.
Yeah, and based on those normalized earnings, you get an earnings yield of about 0.8%.
Less than 1%. So if the company just stopped growing tomorrow, it would take, 125 years to earn back your investment.
That's the math. You're paying for decades of perfect growth right now, up front.
And it gets worse when you look at the assets, doesn't it? The price-to-book ratio.
Oh, yeah. The PB is about 37 times. Graham's limit for a defensive stock was 1.5.
1.5.
So the market value is just exponentially higher than the actual tangible stuff the company owns. You're betting entirely on the intangible, the brand, the tech, the future.
Graham had a test for this, didn't he? The multiplier test, to catch stocks that were expensive on both measures.
He did. PE times PB. And even if we're generous and use the trailing PE, that number comes out to over 1,600.
1,600. And Graham's ceiling was 22.5.
We are so far beyond the ceiling, we're in a different galaxy. You're demanding sustained perfection on both profitability and asset value. It's almost impossible.
Okay, so the final nail in this valuation coffin has to be the net test, the liquidation value.
Right. What are the liquid assets worth after you pay off all the debt? And the filings show that net current asset value per share is only about $3.05.
$3. And we're paying $180. That's nearly 60 times the bare bones asset value.
So yeah, the takeaway from all of this is pretty clear. At $180, that extraordinary future growth isn't just a possibility. It is a certainty that is already fully priced in.
There is zero margin of safety from a valuation standpoint. You're buying the forecast, not the company.
That's the Graham diagnosis, yes.
Okay.
But before we just dismiss it, we have to talk about why the market is doing this. We have to look at the financial fortress that supports this whole thing.
This is the other side of it, because the business itself, its quality, actually passes Graham's tests with, flying colors.
This is what makes it so interesting. The company's financial health is, to put it mildly, bulletproof.
It starts with liquidity, the current ratio.
It's sitting at about 4.5. Graham just asked for a 2. So they have more than double the liquidity he considered safe.
And debt.
Almost non-existent. The debt-to-equity ratio is tiny, 0.07. But the cash position is the real story.
How much are we talking?
Their net cash is about $52 billion. They could pay off all their debt 6 times over and still have billions left. Their operating income covers their interest payments about 460 times.
460 times. So any talk of financial distress is it's absurd. They have an immense runway.
It's a guaranteed life raft. But as you said, we're paying the price of a luxury yacht.
And they pass on size and stability, too. They've had positive earnings every year for the last 10 years, and their main business, data center, is now 90% of all revenue.
They're not just in the AI gold rush. They are the ones selling all the picks and shovels. They have a dominant, essential position.
Okay, so the business quality is an A+, a truly high-grade company. The stock price, however, is where the speculation lives.
Right.
So now let's pivot to the dangerous signs, the risks that are kind of hiding in the fine print of these filings, the things that could actually derail that perfect future everyone's paying for.
And we have to start with the biggest one. Customer concentration. The stock price demands growth from everywhere, but the reality is quite different.
The filings say that in the last quarter, just 4 direct customers made up 61% of total revenue.
61%. And it's all in that key growth engine, the compute and networking segment.
So think about that. If just one of those 4 big customers, the big cloud providers, decides to slow down their spending or, heaven forbid, build their own chips.
NVIDIA's earnings get hit hard. And immediately. And the filings even say that indirect revenue is also concentrated among those same few players.
That brings us to the next point, this huge bet they're making on supply. You see inventory just ballooning. It nearly doubled in 9 months, from about 10 billion to almost 20 billion.
And that inventory is tied to these massive, non-cancelable commitments for future supply. We're talking about $50.3 billion.
$50 billion.
It's a huge leveraged bet that this incredible demand continues without any interruptions from competition, from the economy, or from regulators.
And we've already seen that regulation does interrupt things. The reports detail these huge write-offs, right?
Yeah.
Provisions for inventory.
Yes, a total of $6.7 billion. And the really crucial part is that $4.5 billion of that was a direct charge for H20 chips.
Ones that were impacted by the U.S. export controls on China.
Exactly. It's a perfect, terrifying example of geopolitical risk becoming a multi-billion-dollar loss overnight.
Speaking of which, the filings are shockingly blunt about China, aren't they?
They are. They basically say, and I'm quoting here, that NVIDIA is already effectively foreclosed from the China market for its top-tier products.
So they're constantly in this cycle of designing less powerful chips to comply with the rules.
Only to risk having new rules come out tomorrow that make those obsolete too. And then you add the supply chain risk, the dependence on Taiwan and South Korea. One regional crisis, and their ability to build anything could be seriously impaired.
Let's talk about how they're spending their money. Capital allocation. Because this feels like a place where management is actively, shrinking that margin of safety.
From a Graham perspective, this is probably the most alarming thing they're doing. They repurchased $36.7 billion of their own stock in the first 9 months of the fiscal year.
Mostly near the current price. So they're buying back shares at 40 times current earnings, or over 100 times those normalized earnings we talked about.
It's the exact opposite of what Graham would advise. They're swapping $36 billion of cold, hard, safe cash for their own stock at a price that is, by definition, highly speculative.
They're signaling confidence, sure, but they're reducing the company's financial cushion to do it.
They're swapping certainty for a very optimistic hope.
And then there are these other more complex commitments. The filings show their investments in other companies grew a lot.
Right. Non-marketable equity. About $6.5 billion in commitments to companies like Intel, Anthropic, even OpenAI. These are strategic for sure, but they add another layer of risk and volatility outside of their core business.
There was also that guarantee for a partner's data center lease.
An $860 million guarantee. It's another financial risk, a contingent liability that's sitting on the books for a conservative investor to worry about.
And you also see things like warranty costs and deferred revenue going up. These are future obligations they have to meet, and they have to meet them while maintaining that insane 56% margin. Any slip up there becomes a drag.
It all adds up.
Okay, so let's bring it all together. It's time for the Graham verdict.
And there are really two verdicts here, aren't there? The first is about the business itself.
And on that front,
The business is outstanding. Financially powerful, stable, dominant. It passes every single one of Graham's quality tests. It's a world-class enterprise.
the stock at $180 a share, that is a completely different story.
That's the second verdict. The stock is a classic speculation. It fails the investment criteria because the valuation risk is just immense.
It requires that extraordinary growth and those historic margins to continue perfectly, forever.
With no room for error. No margin of safety for the investor if competition heats up or regulation changes or one of those big customers just changes their mind.
So if you're buying at this price, you are knowingly taking on a huge amount of risk. You're betting on a perfect future.
And that leads to a final thought for you, the listener. Let's just consider the cliff perfection. Graham's models are great for showing how sensitive a stock price is to your growth assumptions.
We've established that the market's optimistic assumptions get you to $180. But what happens if we're just a little more conservative? What if growth just normalizes?
Right. What if, instead of this insane surge, we assume a long-term growth rate of, say, 10% a year?
Which is still a really, really good growth rate for a company this size.
It's fantastic. But if you plug that 10% growth into the model using the same trailing earnings, the implied value of the company drops from $180 all the way down to about $115 per share.
Wow. So that $65 difference from $115 to $180, that's the premium.
That is the premium you are paying today for the expectation of near-perfect, uninterrupted, aggressive growth. It's the price of ignoring all those risks we just detailed in the filings.
So the final question for you is pretty simple. Are you willing to pay a $65 premium for perfection, knowing your capital's exposed if things just become normal? That's the line between investment and speculation.